Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TRONOX Holdings plc annual report. TRONOX Holdings plc offers a diverse range of businesses and services that cater to various industries. The company's primary products include Thai Otwo pigment, ultrafine specialty Thai Otwo, zircon, high-purity pig iron, monazite, feedstock, and titanium tetrachloride. These products are used in the manufacture of paints, coatings, plastics, and paper, among other applications. TRONOX Holdings plc operates a vertically integrated business model, which involves mining, beneficiation, and smelting operations to produce its range of products. The company's global presence spans North America, South and Central America, Europe, the Middle East, Africa, and the Asia-Pacific. In essence, TRONOX Holdings plc provides a comprehensive suite of businesses and services that cater to the needs of various industries, including manufacturing, construction, and consumer goods. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop. The stock price of TRONOX Holdings plc has dropped slightly in the past year due to various market and economic factors. One possible reason is the decline in demand for titanium dioxide, a key product produced by the company. If there is a decrease in demand from major industries such as paint and coatings, it can lead to lower sales revenue and subsequently affect the stock price. Another factor that could contribute to the drop in stock price is increased competition in the market. TRONOX Holdings plc operates in a competitive industry where other companies are vying for market share. If new entrants or existing competitors increase their production capacity, it can lead to oversupply and downward pressure on prices, negatively impacting the company's revenue. Additionally, changes in global economic conditions can also impact the stock price of TRONOX Holdings plc. A slowdown in economic growth or a recession can reduce demand for titanium dioxide and other products produced by the company, leading to lower sales and profits. Lastly, regulatory issues or environmental concerns can also affect the stock price of TRONOX Holdings plc. If there are changes in regulations or increased scrutiny on the company's operations, it can lead to higher costs and reduced profitability, negatively impacting the stock price. TRONOX Holdings plc maintains a market capitalization of $1 billion, broadly in line with the industry peer group. TRONOX Holdings plc trades at a lower price-to-book ratio of 0.77 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 2.92%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The net income of a company underwent significant changes between 2024 and 2025. Initially, the net income decreased from -$54 million to -$473 million, indicating a substantial decline in profitability. Furthermore, when comparing the 2 years, it is evident that the net income dropped by $472 million, representing an increase of 216% in losses. The profit margins also experienced a notable decrease during this period. The gross margin declined from 16.8% to 9.3%, while the adjusted EBITDA as a percentage of net sales decreased from 18.3% to 11.6%. These changes can be attributed to several factors, including lower average selling prices and mix, reduced other products revenue, and higher production costs. The increase in sales volumes of Thai Otwo and zircon partially offset the decline in gross profit. However, restructuring charges, combined with lower sales volumes and average selling prices, higher production costs, and freight costs, ultimately led to a significant decrease in profitability. These factors collectively contributed to the substantial changes in net income and profit margins between 2024 and 2025. The company's financial performance indicates a consistent generation of positive operating cash flow. On page 67, it is reported that cash generated by operations reached $674 million as of December 31, 2025. Furthermore, the operating cash flow for both 2024 and 2025 was substantial, standing at $1.2 billion and $1.3 billion respectively. The net cash provided by operating activities also shows a positive trend, with figures of $60 million in 2025 and $300 million in 2024. Additionally, the cash provided by operating activities for the 3 years from 2023 to 2025 was $184 million, $300 million, and $60 million respectively. The operating cash flow summary on page 108 highlights the company's ability to generate significant cash proceeds from collections and incremental accounts receivables sold. The figures for 2024 and 2025 were $1,051 million and $1,091 million and $1,080 million and $1,106 million respectively. While operating cash flows used for leases have been relatively low at $42 million in 2025, $38 million in 2024, and $40 million in 2023, the overall trend suggests that the company is generating sufficient positive operating cash flow to support its operations. The company's debt level has undergone some changes between 2024 and 2025. Initially, there was no significant change in debt level mentioned on page 29, but subsequent pages revealed a more complex picture. On page 67, it is stated that the debt level increased by $96 million from 2024 to 2025. However, this increase is not consistent across all types of debt. For instance, long-term debt increased by $371 million, page 69, while long-term debt and lease financing increased by $1,430, page 71. On the other hand, page 113 mentions that long-term debt due within 1 year decreased from $6 million in 2024 to $7 million in 2025. In terms of interest expenses, there is a notable increase. According to page 65, interest expense increased by $22 million from 2024 to 2025. This trend continues on page 72, where it is stated that interest expense increased from $167 million in 2024 to $189 million in 2025. The company's debt level or interest expenses have changed significantly, as mentioned on page 73. The increase in interest expenses can be attributed to the company's floating rate debt and hedging strategies, page 77. However, it is worth noting that some pages mention no significant changes in debt levels or interest expenses. For example, page 95 states that there were no significant changes in debt level or interest expenses mentioned. In summary, while the company's debt level has increased by $96 million from 2024 to 2025, the increase is not consistent across all types of debt. Interest expenses have also increased significantly, rising by $22 million from 2024 to 2025. The company's performance varied across different segments and regions. On the positive side, South Africa stood out as a strong performer due to its abundant reserves and successful commissioning of the Fairbreeze extension on page 5. This success was short-lived, however, as net sales in South Africa decreased from 2024 to 2025, according to page 138. In contrast, Australia saw an increase in net sales in 2025 compared to previous years, as noted on page 138. Unfortunately, the mineral sands, HMS deposits segment struggled with varying levels of geological confidence and economic viability, as mentioned on page 43. The U.S. operations also experienced a decline in net sales in 2025 compared to previous years, according to page 137. On the other hand, several regions did not have any performance metrics available, including Stamford, Connecticut, Stallingborough, United Kingdom, Oklahoma City, Oklahoma, Australia's mining and smelter operations. and the Shandala Metallurgical Complex in Western Australia. The management is optimistic about the company's outlook, highlighting several key strategies that will drive future success. The primary goal is to achieve vertical integration by producing feedstock materials in-house, enabling self-sufficiency in Thai Otwo production. This move is expected to deliver low-cost, high-quality pigment to customers worldwide. To support this vision, the company aims to increase sales volumes and average selling prices through a mix of products. Favorable exchange rates will also contribute to improved financial performance. Management has committed to investing in cost reduction, growth initiatives, and mine extension projects, while reducing debt and making quarterly dividend payments. The company's focus on risk management is evident through its use of derivative instruments for hedging purposes. Additionally, environmental expenditures are expected to be funded from operating cash flows. The pension plans are managed to meet future liabilities over the long term. While there may be some areas of uncertainty or concern related to tax policy and internal controls, overall, the company appears poised for growth and success under its current strategy. The company has made several strategic moves through acquisitions and divestitures in recent years. On the acquisition side, two notable deals stand out. In April 2019, the company acquired the Thai Otwo business of Crystal, marking a significant expansion of its operations. Additionally, it is mentioned that the company acquired Crystal itself, although no specific date is provided. On the divestiture front, the company has been actively shedding non-core assets to focus on its core business. This includes shutting down and idling plants in the Netherlands and China, respectively. The Hawkins Point plant was sold to the Maryland Port Administration in December 2022, while a royalty interest in certain Canadian mineral properties was also divested. Furthermore, the company has entered into a settlement deed with AMIC, Crystal, and ATTM, which may involve further asset transfers or other arrangements. The company has a history of paying dividends to its shareholders. In fact, it has been a consistent practice for the company to declare quarterly dividends. For instance, on February 11, 2026, the company declared a dividend of $0.05 per share. Furthermore, the company made significant payments in previous years, including $48 million in 2025, $80 million in 2024, and $89 million in 2023. On the other hand, the company has not engaged in share buybacks. Despite having the financial capacity to do so, the company has chosen not to repurchase its shares. This decision suggests that the company is prioritizing dividend payments over share buybacks, indicating a commitment to returning value to shareholders through dividends rather than reducing the number of outstanding shares. And concerns about inventory buildup or supply chain disruption are evident throughout the report. On page 22, excessive production capacity in China may lead to oversupply and downward pressure on prices, potentially disrupting market dynamics. The Indian anti-dumping duties have been stayed due to procedural issues, which could lead to future disruptions. Furthermore, civil unrest in South Africa has resulted in significant damage to national supply chains and logistics, leading to shortages of production materials, interruptions to transportation networks, and labor unrest, page 27. This could result in production delays and shortfalls. Additionally, lower sales volumes and average selling prices have been reported, which may indicate a decrease in demand for Thai Otwo and zircon products. The financial statements also raise concerns about inventory buildup. On page 86, inventories increased by $101 million from 2024 to 2025, indicating a potential accumulation of unsold goods. The inventory not expected to be sold within 1 year has also increased, with reserves for lower of cost and net realizable value charges increasing by $14 million, page 108. These figures suggest that the company may be experiencing supply chain disruptions or inventory buildup issues. Overall, these concerns highlight potential risks to the company's operations and profitability. Addressing these issues will be crucial to maintaining a stable supply chain and preventing further disruptions. That concludes the financial summary for TRONOX Holdings plc. Feel free to comment below, and I will be happy to answer them when possible.